Walk down almost any British high street over the last 30 years and you would see the same green and yellow sign. Poundland. Everything for £1. It felt simple, reliable and permanent. By early 2026, that picture has changed. Under new owner Gordon Brothers, Poundland has closed around 149 stores, cutting about 2,200 jobs. Store numbers have fallen from around 800 to 825 sites in the United Kingdom and Ireland, down to about 651. This is not just a bad Christmas. In June 2025, Poundland's then-owner Pepco Group sold the entire chain to Gordon Brothers for £1. Not £1 per share, £1 for the whole business. At the same time, Poundland was facing a projected negative EBITDA of about £117 million for the year ending 2025. Pepco also booked an impairment charge on Poundland goodwill of around €775 million, and the wider group reported a net loss of roughly €662 million for fiscal year 2024. On paper, these are dramatic numbers. Many commentators have taken them as proof that the budget store boom is over, that the age of the high street discounter has run out of road. The reality is more complex. The golden era of fast expansion for £1 style chains does seem to be ending. But that does not mean shoppers have stopped wanting low prices. What is ending is a specific model. The high street variety discounter built on a single magic price point. To understand why, you have to go back to where Poundland started. The company was founded in 1990 based on a very clear promise. Every item in the store cost £1. This worked when the value of that £1 was high enough to cover a wide mix of goods. Over time, that value has been eaten away. What £1 bought in 1990 is worth around 35 to 40 pence in 2026. That gap kills the old model. Keeping everything at £1 would mean shrinking pack sizes or stripping quality to levels customers will not accept. So Poundland, like other value retailers, began to introduce higher price points. £2, £3, £5. The business could no longer live on the £1 hook alone. At that point, Poundland lost some of what made it unique. It started to look less like a special place where everything is one simple price and more like a small convenience store with lots of price stickers. The analyst firm Global Data tracked the effect. Between 2019 and 2024, Poundland's market share fell by 2.3 percentage points. Over the same period, rivals using larger big box formats added share. Home Bargains gained about 7.2 percentage points. B&M rose by around 6.2. The shift in shopper behavior is clear. Many people still want cheap ITMs, but they want to do a full shop in one trip. Household goods, snacks, maybe some furniture or garden products. That push has favored chains like B&M and Home Bargains, often based on retail parks with bigger floor space and, in some cases, owned real estate that keeps rent pressures lower. Poundland, by contrast, is heavily tied to high streets and shopping centres. Those locations carried fixed costs that were easier to carry during the growth phase, but became a burden once sales turned down. The problems did not stop with inflation and store format. From fiscal year 2024 into 2025, Poundland's trading numbers worsened. In the year to 30 September 2024, Pepco Group reported overall revenue of roughly €6.2 billion, up just over 10% year-on-year. Yet within that, Poundland's EBITDA fell by about 21.5% to around €153 million. Like-for-like sales in Poundland stores dropped by 3.6% in that year. Pepco's chief executive, Stefan Borchert, was blunt about the cause. He said Poundland's recent performance had been very challenging and pointed to declines in clothing and general merchandise after the chain shifted to Pepco-sourced ranges at the start of the year. The idea was to plug Poundland into Pepco's broader clothing and homeware buying power. British customers did not respond the way the group hoped. There were complaints around sizing, style, and range depth. In simple words, shoppers did not like the new clothes as much and they bought less. By the first quarter of fiscal year 2025, the picture had worsened. Like-for-like sales at Poundland in that quarter to 31 December 2024 fell around 7.3%. For the 6 months to 31 March 2025, Poundland's revenues fell about 6.5%, even as other Pepco formats like Deals grew. At the same time, Pepco had taken on 71 former Wilko stores in 2023. Turning those locations into successful Poundland shops proved harder than expected. All this came against a backdrop of rising costs. The United Kingdom national living wage increase in April 2025 to around £12.21 per hour, and further rises in 2026, hit labour-heavy retailers hardest. Budget chains like Poundland work on thin margins. They cannot easily absorb a wage bill jump of 10 to 15% without changes. Employers' national insurance contributions also went up from 13.8% to 15% in April of 2025. Pepco pointed to these tax changes as a key driver of intensifying pressure in the United Kingdom market. Alongside wages and tax, business rates remained a heavy operating expense. Unlike online platforms such as Temu or Shein, physical discounters pay rates on every store. Pepco and later Gordon Brothers both talked about Poundland's over-rented sites. The restructuring plan pushed landlords to accept lower rents or risk empty units. At the same time, competition was reshaping the low-price space. The so-called Temu effect meant shoppers with a smartphone could order direct from China products at ultra-low prices. A £3 gadget on the high street was suddenly fighting against an 89p version on an app. Large supermarkets also stopped giving budget chains an easy ride. Tesco with Clubcard prices and Sainsbury's with Nectar prices heavily promoted loyalty deals. They claimed price matches against Aldi and Lidl on more than 500 key essentials. The old idea that Poundland was always cheaper for toiletries and snacks started to fade. Put all of this together and you can see why Pepco decided to walk away. By mid-2025, the group cut its profit expectations for Poundland, then agreed to sell it to restructuring specialist Gordon Brothers for £1 in June. The sale at that symbolic price showed how little standalone value Pepco saw left in the United Kingdom chain compared with the cost of turning it around. So is this the end of the budget store boom? Many headlines say yes. They point at the £1 sale price, the 149 closures, the 2,200 jobs lost. They note Pepco's shift of focus to Eastern Europe, where its Pepco-branded shops continue to grow. They argue that if a giant like Poundland can no longer make money out of British discount retail, the model must be broken. The data does support the idea that one type of discounter is in retreat. Poundland's like-for-like sales fell 3.6% in fiscal year 2024, then another 6.5% over the 6 months to March 2025. The group booked a €775 million write-down on Poundland and ended the year with a net loss of about €662 million across the whole business. By early 2026, Poundland had cut its estate by around 150 to 170 stores and was closing distribution centres, shutting online sales and ending its Perks loyalty app. Yet there is another way to read the story. The winners and losers in discount retail are changing place, not disappearing. The same period that saw Poundland weaken also saw B&M and Home Bargains report market share gains. Home Bargains has been growing with destination sites, often owning its own property. B&M has focused on retail park big box stores offering furniture and garden goods as well as fast-moving consumer goods. Pepco itself is growing in Eastern Europe, even as it exits Poundland. That suggests the problem is not discount retail as a whole. It is the specific mix of high street locations, single-price heritage, and product strategy mistakes. You can see this in Poundland's recent actions under Gordon Brothers. The plan is not to give up, but to shrink and refocus. The High Court approved a large restructuring in mid to late 2025. By January 2026, the company had closed 149 stores, cut 2,200 jobs, and dropped several categories including chilled and frozen food, online sales, and the Perks app. It has gone back to basics on pricing. Around 60% of grocery items are now back at the £1 level. Managing Director Barry Williams described it this way: "While there's been significant progress as we refocus and re-energize the business with lower prices and a sharper offer, we know we still have much to do." In another comment, he said large-scale closures were now in the rearview mirror and that the chain was returning to a back-to-basics approach. Supporters of the plan argue this is what customers wanted all along. Simple value, core groceries, everyday branded goods, less distraction from clothing experiments and frozen trials. There are some early signs that the surgery is having an effect. In the quarter ending 28 December 2025, Poundland's EBITDA rose to about £17.3 million, up from £8.9 million in the same quarter a year earlier. Unit volumes in fast-moving consumer goods increased by around 9%. Like-for-like sales were still down about 2.9%, even after stripping out discontinued lines. That shows that fixing the model is a long process, not an overnight bounce. So what warning does this send about the budget boom? One common view is that rising wages, higher taxes, and energy costs mean deep discounting no longer works. Another is that apps like Temu have stolen the bottom of the market, so physical value stores are doomed. The evidence from Poundland suggests a more targeted lesson. It points to the end of the high street variety discounter, built around a single headline price. Inflation eroded the value of that £1 promise. Attempts to stretch into clothing and broader general merchandise left the chain exposed when shoppers did not like the ranges. Cost pressures then removed the room for error. At the same time, the value boom has not vanished. It has moved. First to retail parks, where B and M and home bargains attract bigger baskets from car-born shoppers. Second to online, where Temu and others avoid business rates and can live with razor-thin margins on individual ITMs. Pepco's decision to sell Poundland while investing in Eastern Europe shows that their management sees the United Kingdom, not discount retail overall, as the problem market. So when you hear the idea that the budget store boom is over, it is worth asking, which budget stores? Poundland's collapse into a £1 sale and painful restructuring is a clear warning for high street chains that relied on a magic price point and a mix of impulse buys. It is less a story about people turning away from low prices and more a sign that the old £1 model no longer fits a world of higher costs and tougher rivals. The end of the boom is really the end of a specific format. A chain of small variety stores on busy high streets promising everything for one coin whose value has steadily shrunk. The boom has simply shifted to those who can offer low prices with either much bigger baskets in out-of-town sites or far lower overheads online. Poundland's job now is to find out whether a smaller, more focused version of itself can survive in that new map of discount retail.